Hi there, welcome to Kneppyinvests. One of the best ways to find a breakout of the share price in a company is to look at all the announcements released during a week and see how the market has reacted to those announcements. In this video, what I'll be doing is focusing on 5 companies that released interesting announcements to the market, and we'll just see how the market has responded, and possibly there could be a potential buy somewhere in there. So let's get stuck into it and look at the first company, which happens to be Corvus. This is a company I've done a video in the past because it does look cheap. This is a profitable company with a market cap of only 59 million, revenue of 59.6, and operational cash flow positive. Corvus was founded in 1970. They manufacture and supply cable and pipe support systems, galvanizing services, and access systems for large mobile equipment. On July the 5th, they released profit guidance, which actually is a profit upgrade. And I have found through time that the most powerful sort of announcement a company can release is a profit upgrade. The market loves those sort of announcements the most. And this was a profit upgrade compared to their expectations they released on May the 6th of this year. In that release, they expected profits for the second half of financial year 21 to be between 3.3 and 3.8 million. Now their expectations are between 4.4 and 4.7 million. That's a 33% rise in expectations. That's a significant profit upgrade. The other thing I wanted to find out is how this company has performed in the last 5 years. So I went to ticker, TIKR, and I just looked at their financial statements over the last 5 years, the semi-annual financial statements and the income or the net income, which is profits, just to see how this company has performed, to see if profits have been increasing on a semi-annual basis for a period of time. And what I saw actually did surprise me a little bit. This graph comes straight from ticker, looking at the net income or profit of Korvest over a semi-annual period going back to, looks like that's the second half of financial year 2016. If we go back 4 or 5 years ago, this company was not very profitable, if at all. In fact, there were 2 half years where they were not profitable. And the worst half year was that first half of financial 2017, and that carried through to the second half. So that year, financial year 2017, they were not profitable at all. But ever since that low point, we've seen a steady increase in profit for this company, potentially a change in manager, that sort of thing. I would like to find out what turned around this company's performance and fortunes. And if we take into account their expectations for this half year, it totally blows away the performance of this company in previous half years. So we've gone from 2.8 million in the last half year to expectations of 4.4 to 4.7 million. It does raise one question, whether those tailwinds behind the performance of this company can continue or whether they're just taking advantage of short to medium term factors. That does raise one interesting question. The other question is, this company's been around 50 years, so why hasn't this company performed as well as it's doing now during those 50 years? Or maybe right now, Corvus has just found itself in the right time, right place, and maybe this could be the impetus for this company moving forward, and now we'll see this company grow. We have seen this in the past. Just have a look at Altium's history, and you can see Altium for a long period of time was just going flat. Weren't growing the revenues much at all, and they hit a inflection point and their revenues just exploded. So maybe Corvus could see the same thing. Of course, Altium and Corvus are 2 completely different businesses, but it does happen where you see a company not really perform well during a period of time, and then all of a sudden something happens and they just their performance hits a rocket and it just outperforms their expectations and everyone's expectations as well. Onto the weekly chart for Corvus. This goes back to 2015 when the share price was dropping like a rock, and it dropped all the way down to $2 in 2000 or late 2016, and then it consolidated around that $2 to $2.50 mark for a period of time. And that was the low point in the financial performance of that company. Remember, they were not profitable in 2017. And it took a little bit of time before they became profitable and the market to become interested in this company. Turnaround in the share price happened around mid-2018. We saw a crossover of the shorter moving average, or the short-term moving averages, going above the longer-term moving averages. And that was a sign that there was a shift in sentiment around this company. So that happened around about, say, August of 2018, share price around the mid-$2. And ever since then, the share price has been generally going up. We have seen some significant rises in share price quite quickly, and then significant decreases in share price. That's a sign that there's not a lot of liquidity in this company. You sometimes see that, particularly in companies which don't have many shares on issue. Corvus doesn't, and you know that because the market cap of this company is $50 million, yet the share price is $5, which means there's about 10 million shares on issue. Maybe a lot of those shares on issue is owned by management. Right now, share price is at $5.30, which is at about a 6 or 7 year high. That is the sort of company you do want to buy into when the share price is at a long-term high. You might be a little bit patient, and if the share price falls back towards $5, $5.10, that could be a time to buy into Korvest. On to Ordinate. This is a company I do have a little bit of history with. I was a shareholder of this company for a fair while. And then I just could not justify the valuation of this company, particularly when you looked at the growth trajectory, what we saw. But this is one of the most favorite companies among many fund managers because they do have not a lot of competitors. In fact, a lot of the competitors are dying off. And so a lot of fund managers love that thing. They believe this company has a significant moat, dying competitors, and that's the main reason they love this company. Seems like they don't look at the valuation, $657 market cap, a revenue only $29.5 million, and operating cash flow 5.2. So you can see operating cash flow of Audinate is very similar than Korvest, yet Korvest has a market cap of 50 million, Ordinate has 657 million. So you can just see the different expectations around these two companies. So what does Ordinate do? Well, founded in 2003, Ordinate develops and sells digital audio-visual networking solutions. They are a global company, and as I mentioned before, a lot of the competitors aren't really growing, so Ordinate is growing. On July the 9th, last trading day of the week, they released a trading update. The market loved this trading update. They released the financial year 21 revenue expectations, or I think it was unaudited revenue, which is 33.4 million. So this is not a range, this is the unaudited results, and more likely that's what the results we'll see in regards to revenue. They gave it in US dollars because it looks better because of the exchange rates. So they also gave it in Australian dollars. So I'm just using Australian dollars here. When you look at the American dollars and increase from financial year 20, it does look way more impressive. I can understand why they did that. Financial year 20 revenue in Australian dollars was only 30.3 million, so only a 10% increase in revenue. And they also mentioned, and maybe this is why the market loved it, fourth quarter revenue up 74% compared to the previous corresponding period. And they also had a successful launch of the first OEM Dante video products. Using Ticker, this is just the half-yearly revenue numbers for Ordinate going back to the second half of financial year 2016. In that half year, they recorded $6.6 million of revenue, and they've grown that to $15.4 million in the first half of financial year 21. Based off their unaudited revenue results for this half year, the last half year of the financial year 21, they will see numbers around $18 million or more, which would be a record results for revenue for Ordinate. So revenues are still increasing. It did look like there were a period here, the last 5 half years, where revenue looked like they were going sideways. And that's one of the reasons I decided to set out of this company, just because I wasn't seeing the revenue growth that I really want to see for this company, particularly if their competitors are losing business. Before we get to the weekly chart for Ordinate, I just want to talk about the largest shareholder in Ordinate, which actually happens to be Yamaha. They own 8% of shares in this company. The third largest shareholder is actually Australian Super. They own 5.7%. But let's get back to Yamaha. I can completely understand why Yamaha would be interested in Ordinate. And it wouldn't surprise me that Yamaha would be interested in completely taking over Ordinate in the future. I could be completely wrong with that. Potentially, maybe there is another reason why Yamaha has bought into Ordinate. But the simple fact is, Yamaha is interested in Ordinate, and that bodes well for the future of this company. Now let's get to the weekly chart for Ordinate, which goes back to mid-2017, and we can see the share price go through a nice uptrend from that middle period of 2017 when the share price was less than $1.50. It rose from $1.50 to a high of $9.20 just before the COVID-19 financial panic. And then the share price of Ordinate fell off a cliff, but recovered really quickly. In fact, the share price went from that high of $9.20 to a low of $2.50 and then recovered very quickly. This is the very definition of a flash crash. It's not really a correction. Some people call this a correction. I call it a flash crash. You can just see the share price just fall off a cliff and then rebound just as quick. Since then, we've seen the share price get back to $9.20 in about March of this year, or just prior to March, and then retreat. And share price right now is back to that high we've seen twice before. So that share price around $9.20 is a resistance level. And if we do see the share price move above that $9.20 on good volume, that means we're at all-time highs with the share price. And that also means $9.20, instead of being resistance, becomes support. So it'll be very interesting to see what happens with the share price over the next few trading days to see whether it can get above $9.20 on good volume. Onto an online marketplace company called Mydeal.com.au. I'm not sure if you have to use the .com.au in core or naming this company, or just say Mydeal. However, that .com.au is in the name of the company. This company listed on the ASX in October 2020, so we don't have a lot of history to play with. However, they did provide us with some interesting graph like the one I provided here in regards to gross sales going back to 2011. They did release a trading update in regards to how gross sales and active customers have increased in the past year. Gross sales are up 111% to the previous corresponding period. Active customers up 83% to the previous corresponding period, and that number is at 894,000. To be considered an active customer, you have to use or go to the website and use it at least once in the past year. Market cap of Mydeal.com.au, 189 million, does seem fairly cheap for a company that is expanding quite quickly and in a sector that is going to be growing quite significantly in the next 5 to 10 years. You can definitely see that just with their gross sales growth over the past few years, helped by COVID-19. I do think right now the market is completely mispricing this company, particularly because the growth potential in Mydeal.com in the next 5 years is considerable. Onto the chart for Mydeal. Since they listed on the ASX, a little bit of hype on listing. Share price went to a high of about $2.20 and then fell off a cliff in the next 3 trading days. And ever since the start of the calendar year, the share price in Mydeal has been in a downtrend. In saying that, it does look like the downtrend could be coming to an end. We do have some positive signs in the past 2 months. The share price got to a low of around 52 cents in the middle of May, and we have seen a higher high and a higher low setup. We've definitely seen a higher low. So the last 2 lows, just look at those 2 lows, and the last low is higher than the low before that. And we've seen a potential higher high as well in the last 3 trading days. This horizontal blue line I've got there in the past month or so is a resistance level, and that coincides with the previous high in late May at around 70 cents, and the share price has been struggling to get above that in the last 3 trading days. If we see the share price move towards 75 cents, that could be confirmation that the share price is moving into an uptrend in this company, that the sentiment is shifting, and there is potential I will be taking a position in this company in my short-term sentiment portfolio. I already own this company in my long-term buy and hold portfolio because I do think there is potential value when you look at the valuation of this company, compare it to the potential, particularly the long-term potential of mydeal.com.au. SRG Global is another company I have actually done a video in the past. I'm very close to taking position in this company. One of the main reasons I didn't is I already own 3 or 4 mining services company. I didn't want to overweight my holdings in that area. SRG Global is a construction and mining services company. They do a little bit more than that. Founded in 1961 as Structural Systems Limited, they've gone through some name changes, and in 2018 they merged with Global Construction Systems, GCS. I've always wondered what happened to that company. Well, I found out doing my research on this company. On July the 7th, SRG Global issued financial year 21 guidance and financial 22 outlook, which is one of the first outlooks I've heard about. I'm not sure it's wise to give financial year 22 outlooks just yet because a lot can change in the next few months or even the next 6 months. They're expecting financial year 21 EBITDA to be between 45 and 47 million. I was almost happy to see they were giving mention to operating cash flow. I wish more companies do this because, in my opinion, operating cash flow is one of the most important metrics a company can give us. But they didn't quite give us. They sort of indirectly gave us their operating cash flow by mentioning how they've improved their cash on hand. So they were net debt by something like $12 million this time last year, or maybe it was $8 million, and now they're net cash by $12 million. So there was an improvement of $20 million when it comes to their net cash. So I just said that's an assumption, they made the assumption that's operating cash flow of about $21 million. And the outlook for EBITDA in financial year 22 is 15% higher than financial year 21. I'm taking that with a grain of salt because more than likely that's going to change by a significant amount because I don't think a company can quite have a handle on how they're going to perform in financial year 22 at this point in time unless a company is highly stable. And I don't think SRG Global would fit into a highly stable sector. That's just my opinion. Instead of using TradingView for charting purposes for SRG, I've actually transitioned to ComSec for one simple reason, and that simple reason was how I discovered there was a merger between SRG and GCS because there was some significant discrepancy in the chart for this company in 2018, and I did not see that discrepancy in the ComSec chart you see here, and that's how I discovered that merger. Now, looking at the weekly chart for SRG going back to 2016, share price was actually a nice little uptrend. Share price got to a high of 90 cents towards the end of 2017 and the start of 2018. And from that high, nice downtrend then developed until we saw the share price get to a low during the COVID-19 financial panic around 20 cents. And that low followed up a few months later. And then we've seen the share price and the sentiment in this company turn around. Some good financial news has occurred or been released from the company. And we've definitely seen, just by looking at the weekly chart, the share price in this company is in an uptrend. And the share price right now at 55 cents is, we'll say, almost a 2-year high. Last company I want to talk about is Objective. This is an info tech company that offers objective enterprise management related products, allowing customers to manage info and process governance. Founded in 1987, so this company has been around for a long time. You won't know that by looking at the share price action over the last few years. Market cap of $1.7 billion. Revenue of only $82.8 million and operating cash flow 23.4, and even the profit after tax only $16 million for financial year 2021 and $11 million for financial year 2020. So if you take that net profit after tax for this financial year of $16 million and look at the market cap of $1.7 billion, that means the price to earnings ratio of this company is more than 100. And without even looking any further, I know this company is completely utterly overvalued for where they are, even though this company is experiencing some good growth rates, and they provided us with those growth rates in their profit guidance on July the 9th. Revenues increased 36%, Annual recurring revenues increased 31% to 74.2 million. EBITDA has grown 49%. Net profit after tax has grown 45%. Cash balance has grown 48%. Price to earnings ratio of 100 is simply ridiculous. And the way I look at this is there's more risk in holding this company than reward because of that price to earnings ratio. Even if you look at the price to sales, quite high there as well. Revenue of 95 million. We're looking at the price to sales of about 20 or even more than that. And that, again, is a company that is, in my opinion, overvalued. But when you look at the share price action over the past few years, you won't see that, or the market is not seeing any overvaluation in this company. So this is just a personal thing. If you're holding this company, I probably would not sell just because the share price is in a nice, well-defined uptrend. Again, using Ticker to look at the half-yearly revenue and operating cash flow for Objective going back to 2015. The growth rate in revenues has been solid, not exceptional, and with a company with a price to earnings ratio of 100, you would expect more significant growth than this. And operating cash flow is quite lumpy as well. In fact, the previous half year, they had $3.5 million of operating cash flow. So in my opinion right now, there's too much risk in this company to hold for the potential rewards in the future. I wouldn't be surprised to me to see the share price of this company remain at the current share price for like 5 years, and even then, with the growth rate of this company, it still could be overvalued. So I try to stay well clear of these sort of companies simply because of the risk involved. This is the 2-year chart, daily chart for Objective. And if we go back to 2019, around this time, the share price was $3. Now it's around $18. That means the share price has sextupled in the past 2 years. If you look at the financial state of the company, well, net profit after tax, operating cash flow, all those financial metrics have definitely not grown at 6 times. That means this company's share price has increased because of multiple expansion. It means the PE ratios have ballooned over the past 2 years. It also means the market is expecting the financial growth of this company to explode in the next few years. So if you're buying this company right now at $18, your expectations of the growth rates in this company is to actually increase from what they gave us in this report on July 9. So you have to keep that in mind if you're thinking of buying this company right now. For me, the risk rewards are heavily swayed towards the risk. There's just too much risk for me to take a position in this company. I like to take positions in companies where it's more swayed towards the reward side. So that's the main reason I would not buy into this company right now at these lofty valuations. But if you look at the chart, nice uptrend. So if I was holding Objective right now, I'd probably continue holding until I see signs the share price is under pressure. That is all I have for this video of my 5 ASX stocks of the week. If you have a differing opinion than my own, make sure you leave a comment in the comment section. I love to read about your different opinions because that's how I grow as a person and as an investor, to get different opinions than my own. How am I expected to grow if I don't go outside my comfort zone? And in fact, that's a problem we're experiencing right now with social media. People tend to hone in on those Facebook groups that align to their own way of thought, their own thinking, their own prejudices, their own biases. And if we don't get outside our comfort zone, we just cannot grow as people and as investors. If you do need financial advice, I'm not a financial advisor, so try to seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Talk to you later. Bye.